Welcome to The Explainer. Today, we are going to tackle the two most fundamental ideas in the entire financial world: equity and debt. Honestly, think of them as the basic language of the market. Once you get these two down, everything else just clicks into place.
So here's how we're going to break it all down. First, we'll start with a really simple choice every single business has to make. Then, we'll learn to speak equity and speak debt. And finally, we'll see what happens when those two worlds crash into each other. All right, let's get into it.
It really all begins with this one simple question. A company has a great idea, it wants to expand, build a new factory, hire more people. It needs cash. And to get that cash, it comes to a fork in the road with two very, very different paths it can take.
And that brings us right to our first section, the fundamental choice. Because this decision isn't just about money, it actually forges two completely different kinds of relationships between a company and the people who fund it. It all boils down to this one question. Do you want to be an owner or do you want to be a lender? If you choose equity, you're an owner. You get a piece of the action. Your potential return is unlimited, but so is your risk. You're in it for the long haul. With debt, you're a lender. You get a fixed, predictable return with much lower risk, but it's for a limited time. I love this analogy. An equity holder is a partner on the journey, while a debt holder is just the banker for the trip.
Okay, so let's walk down that first path, the world of the owner. Let's say you buy a share of a company. You own a piece of it. But what is that piece actually worth? Well, as you're about to see, there's more than one way to answer that question.
We can start with something called face value. That's kind of like the original price stamped on the share certificate, mostly used for accounting. Then you've got book value. This is what the company is worth on paper. If they sold off everything they own and paid off every single debt, what would be left for each share? But the one we hear about every day is the market value. That's the price people are willing to pay for it right now on the stock exchange. It's all about supply and demand.
But there's a deeper level, something the legendary investor Warren Buffett calls intrinsic value. This isn't about what the company is worth today. It's about trying to figure out what it's truly worth based on all the cash it's going to make for the rest of its life. For a lot of serious investors, the entire game is finding companies whose market price is way below their intrinsic value.
Now, what if you didn't want to buy just one share? What if you wanted to buy the whole company? Well, the price tag for that is its market capitalization, or just market cap. It's super simple math, but it's a really powerful number. You just take the price of one share and multiply it by all the shares out there.
So let's make that real for a second. Imagine a company has 100,000 shares trading out in the world, and today's market price is $20 a share. You multiply those two numbers together, and you get a market cap of $2 million. That is, in theory, what it would cost to buy the whole shebang on the open market.
Okay, so we know how to put a price tag on a company, but that doesn't tell us if it's actually a good company, right? So how do we measure its performance? That brings us to the next part of speaking equity, looking at the key numbers that tell us how well the business is actually doing.
And the absolute bedrock of performance is earnings per share, or EPS. It's a pretty straightforward idea. You take the company's total profit for the year, and you divide it by the number of shares. What you're left with is your little slice of the profit, the amount earned for every single share you own. The higher the EPS, the more profitable the company is.
But that leads to the real million-dollar question for every investor, doesn't it? A stock could have a high price, but does that mean it's expensive? Not really. We have to connect that price to what the company is actually earning. So how do we figure out if a stock is cheap or if it's way overpriced? Well, to answer that, we use ratios. These are like little tools that help us see the story behind the numbers. The most famous is the price to earnings, or PE ratio. It basically asks, for every $1 the company makes in profit, how many dollars am I willing to pay for the stock? You've also got the price to sales ratio, which does the same thing for revenue, and the price to book value ratio, which compares the stock price to what the company is worth on paper. These tools are absolutely essential for judging value.
All right, let's completely switch gears now. We're leaving the world of ownership and entering the world of the lender. When you invest in debt by buying something like a bond, you're not buying a piece of the company. You're buying a contract, a legally binding promise that the company will pay you back.
And pretty much every one of these debt contracts is built on three key parts. First, there's the face value. That's just the size of the loan to principal. Second, you've got the coupon rate.
That's the interest rate you're going to get paid. And third, there's the maturity. That's the end date, when the company has to pay you back the whole loan. But here's the thing. That coupon rate doesn't tell you the whole story. The much more useful number is something called the yield to maturity, or YTM. Why? Because while that interest payment is fixed, the price you pay for the bond on the open market can go up or down. YTM calculates your total return, taking into account the price you paid and all the interest you'll get if you hold it till the very end. It's the real measure of your return.
Now, for a bond investor, the biggest fear is a change in overall interest rates. And we actually have a way to measure how sensitive a bond is to those changes. It's a concept called duration. It's pretty simple. Bonds with a high duration, which are usually ones that mature way out in the future, are way more sensitive. Their prices will swing up and down a lot more when interest rates change.
So we've painted this picture of two completely separate worlds, right? You've got the owners over here and the lenders over there. But what happens when those worlds collide? Well, in our last section, we're going to look at the weird and wonderful things that live right on that border. You see, the world of bonds is actually way more creative than you might think. There are bonds that pay no interest at all, there are bonds the company can pay back early if it wants to, and others that the investor can cash in early. But the most interesting one for our story today, the one that really blurs the lines, is the convertible bond.
And this is where our two worlds finally meet. A convertible bond starts its life as a regular old loan. It pays you interest, it's pretty safe, but it's got a superpower. It holds the option to transform itself from a loan into ownership, into a certain number of shares of the company's stock. It's the ultimate financial hybrid, giving you the safety of debt with the exciting upside of equity.
So why does any of this matter? Why go through all this financial jargon? Because once you understand this language, you start to see it everywhere. It helps you make sense of the financial news. It gives you the tools to evaluate a company for yourself. You start to understand the health of the whole economy, and it can help you make way smarter decisions with your own money.
If you walk away with just one single idea today, I hope it's this one. Equity is a bet on a company's future. You're saying, I believe this company is going to grow. Debt, on the other hand, is a contract based on a company's present stability. You're saying, I believe this company is stable enough to pay me back right now. One is a vote on the future, the other is a contract on the present. So I'll leave you with this thought. The market is constantly telling a story about success, about failure, about fear, about excitement. Now that you know the basic language of equity and debt, what's a story you can start to hear?
Thanks for joining us for this explainer. We'll see you next time.